Governor Carstens is the governor of the Central Bank of Mexico. He's done that since 2010. Formerly, he was the finance minister of Mexico and has had many other major posts with the IMF, the World Bank, and many other major international institutions. Kevin, former colleague as well. He was a member of the Federal Reserve Board as a governor from 2006 to 2011, so was there during the fun times. Was special assistant to the president from 2002 to 2006 in the White House. Prior to that, investment banker with Morgan Stanley. Now affiliated with Stanford, where he's a lecturer, and the Hoover Institute, and also advises major investment firms. And then Mark Okada, who's the Chief Investment Officer of Highland Capital Management, which manages over $18 billion. It's invested in global alternative credit managers, including hedge funds, private equity funds, and also collateralized loan obligations. Welcome. We're delighted to have you here. We want this panel, we're going to have two panels this morning, and we really want this panel to focus on the origins of the Fed, the role of the Fed and other central banks, and the impact of the Federal Reserve Board and central banks on the growth of the economy. I'm sure we'll get into some of the things that have happened recently, but I want us to particularly start off talking about sort of a tutorial on the Fed, and I'm going to ask Kevin to start. And Kevin, give us a reason. I think the Fed's 100 years old. You know, why was it created? What does it do? Does it help stimulate economic growth? What does it do when we're overheated? What does it do when we're too slow? And what does it do during a financial crisis? So,
thank you, Al. It's great to be here. It's an honor to be here working with colleagues, both domestic and foreign. I will tell you that the U.S. hasn't had a better partner on some of these international finance issues, especially during the crisis, than Governor Carstens and our colleagues from Mexico. So the partnership we have on the economy certainly transcends to central banks, so it's wonderful to be here. So I'll give you a brief history of the Fed, but it's a little tough to do it in front of the great historian of our time in monetary policy and Chairman Bernanke. So to the extent that I wander off, he will mark my paper negatively at the end of the class today. But I would say the central bank that we now know is really the U.S.'s third experiment at a central bank. And it's the third experiment because perhaps the first two didn't go as well as the proponents had planned. This Federal Reserve that Chairman Bernanke chaired, where I served as a governor, was really a response created 100 years ago as a response to the panic of 1907. And as we'll talk a little bit about when Al gets into questions, understanding the role of this central bank to respond to a financial panic is really pretty critical. So during much of the 100-year history of the Fed, there were not panics. The central bank was in the regular business of trying to ensure price stability, trying to ensure that the economy could prosper for long periods of time, not try to get rid of a business cycle, but try to make sure that the economy was able to perform as best it could. So I would divide it, Al, and answer your question to two pieces. One is the central bank as a panic responder, able to respond to a set of financial conditions which are rare but deeply troubling for the U.S. and the global economy. But more benign times, during more normal times, we use a range of tools, most obviously an interest rate tool, to try to either do what we can to lower the cost of funding, to provide more or less credit to the overall economy, to really maximize growth over a long period of time.
Good. Thank you, Kevin. Governor Carstens, so explain how the Central Bank of Mexico works. Mexico, which is doing very, very well, is still a developing country, and is the central bank of developing country different from the Fed? And then I'd like for you to sort of also talk about the Central Bank of Europe. So.
Okay. Well, thank you very much, and it's also a pleasure to be here, especially with such good friends like Ben Bernanke, Kevin, Richard Fisher, John Williams. Well, to start with, I think that in general, most central banks are converging to a model in which usually to preserve the value of the currency, of the national currencies, is one of the main objectives. It might not be the only one, but probably is the predominant one. I think that in every central bank, some of the characteristics of the monetary history of the country is reflected in the mandate and in the way the central bank is organized. Mexico has the probably not that encouraging privilege of having had the first hyperinflation of the 20th century. Usually in the economic history, the German hyperinflation is thought to be the first one, but we had the first one at the time of our revolution. Since then, I mean, it took some years for the Banco de Mexico to be created. It was founded in 1925, and by and large, it performed relatively well until like the mid-70s. And from the mid-70s to early 90s, we had a very proactive monetary policy in a way geared by fiscal considerations. So we had the time of very rapid inflation, which imposed a huge toll on the well-being of Mexico. You had your recent crisis in 2008. Just for you to imagine, we had 3 subsequent major financial crises from the 70s to the early 90s, with a very large cost on our economy. Usually, those costed at least 10% of GDP. Here, we're talking balance of payment crisis, fiscal crisis, banking crisis, and a lot of it was stimulated, or those crises were associated with a central bank that was dominated by fiscal considerations. What does it mean? That the central bank was financing the fiscal deficits. So thank God the Mexicans, the Mexican population got sick and tired of this, and finally a social consensus was formed to have an autonomous central bank. And Mexico probably is, if not the only, one of the very few countries in which the autonomy of the central bank is enshrined in the Constitution. And our sole mandate is to preserve price stability. Now, that doesn't mean that we don't care about growth. We will support growth as long as it doesn't conflict with our inflation objective. But more than anything, especially in the case of Mexico, it is very clear that when we did the poorest in terms of economic growth and even income distribution, because financial crises are very bad for income distribution, it was at the time where inflation was out of control. So it's very clear to have a stable currency, to keep low and stable inflation is a pro-growth objective. No? When we have done the best is precisely when inflation is the best behaved. So I think it's a nuance. I mean, we don't have a clear dual mandate, but in a way you could say that it's implicit in it. No? So that's the way it has worked since we got our autonomy in 1993. It started operated in 94. And I would say that now, 20 years later, the objective has been achieved. I think inflation, before it was in the minds of everybody, now it's almost an afterthought. The peso, I would say that we had a major test with having the main economy in financial difficulties in 2008-9 and in subsequent years improving. But for us who are so closely connected, it was a major test for us to sail through the crisis without having a major financial crisis ourselves. And we managed that. Our currency was well behaved, inflation was kept under control, and now we don't have fiscal dominance, which is really important. That means that the federal government, when it wants to spend, it has either to raise taxes or borrow, but certainly cannot use the money from the credit from the central bank. Now, in case of the European Central Bank, well, that's a far more complex arrangement. Here we have, I think today, 18 countries that have delegated the authority of monetary policy to a regional central bank. It also has as its main mandate the preservation of price stability, and in a way that also has to do with the perception of, in many countries, that should be the main goal of a central bank. I think that the decision-making process is far more complex because you have to, in a way, synchronize the views of 18 different regions. And it has its pros and it has its cons. I mean, the idea of having a single currency in Europe has brought some benefits, but I think it also has brought some difficulties. And the main difficulties is just to think if the monetary policy for the whole region is the best monetary policy for each single country member. And that is not necessarily always the case, and that generates some tensions.
Yeah, thank you. Before I jump to Mark, I want to just quickly ask Kevin about this, the dual mandate, because in the U.S., I think there's a dual mandate that the Fed has that's in legislation in the creation of the Fed, which has caused some consternation on the part of some people, and so could you share with our audience exactly how that works and how that differs from the single mandate that Mexico and Europe has?
So more than a generation ago, the Federal Reserve statute was amended to give the Federal Reserve the so-called dual mandate, saying that when the Federal Open Market Committee gets together, we should be solving not just for price stability to ensure that inflation stays low and moderate, but we should also be thinking about unemployment. We should also be thinking about implicitly the growth of the economy, trying to maximize sustainable long-term employment. And as the dual mandate is discussed, it's often discussed as if there's tension between these two parts of the mandate. I think most of us in central banking think that the two parts of the mandate are actually quite consistent. In normal times, the job of the central bank is to ensure price stability, make sure that households and businesses understand that inflation will be delivered at an expected rate, the rate that most of us have agreed around in central banking around the world is around 2%. We have different ways of describing that, different bands for acceptability, but we say that if we deliver inflation of around 2%, we will have sustained that part of our mandate. Now, most of us think that if we can deliver that inflation stability, that price stability, that's a necessary precondition to long-term growth. That's an essential element to ensure that the unemployment rate can get as low as it sustainably can. And so I think most of us believe in normal times these are not inconsistent with each other. Now, if you try to evaluate how have the remits, the mandates of central banks impacted the behavior in Mexico, the US, the European Central Bank, and others around the world, you'll see that we all have different directives from our parliaments, different directives from the legislators. The European Central Bank has a single mandate, but I wouldn't make as much of it as the headlines. We all spend a lot of time with each other. The critics might say there's a certain groupthink to central bankers, and by hook or by crook, we all basically do the same thing. Now, we do it in different times, in different ways, using different tools, but it is not obvious to me that the changing of the remit, that a differentiated remit between the Europeans and the US or the Japanese and the Europeans drive huge changes in policy. So there's been much discussion in Washington, Al, about the dual mandate, whether we'd be better off with a single mandate. I tend to think that there's more attention that's paid to that than the ultimate difference would be in policy.
Right, thank you. Mark, you're in the real world. Every day you're investing $18 billion plus and looking for the right opportunities for your clients. So do you worry about the Fed, and does it have an impact on your investment decisions?
Absolutely. If you think about what the Fed is doing or has done in this idea of price stability, the most important asset globally, the most important asset is the yield curve, right? Treasuries and the T-bills. And that price and that discovery of that price sets all the other assets across everything that we look at, and how we price risk, how we judge risk. It's the voltage through the whole system. It is the scorecard that we all use in order to apply our capital in the most risk-adjusted way to grow that capital over time. And so I would tell you that my perspective, listening to the experts today, is that there seems to be, has been over my career in the last 35 years, there's been a lot of change in how monetary policy has been executed. And this movement that we were talking about, the dual mandate, really is maybe one of the things that gives me a whole lot of sort of issues when we think about it. Because certainly the idea of inflation is very detrimental, and fighting that and keeping price stability or deflation, we can look at Japan, for example, is certainly a problem. And keeping that problem off of our plate so that we can focus on allocating capital is certainly something that is wonderful. And you know, President Bush talks a lot about freedom, and I think our free markets and our free capital system is one of the greatest assets of this country that certainly creates a lot of growth in and by itself. But when we get into the dual mandate, one of the concerns that I have, and the things that I've been seeing as I sit at my turret and try to allocate capital, is there seems to be a much more politicizing of the Fed. The independence of the Fed this is the place where the rubber meets the road as far as that's concerned. Because now the mandate is not just price stability. There's this nebulous thing called growth and full employment. And it's such a big topic. This is a job that is massive, and it takes everybody to do it. There's private investors, there's certainly the federal government in the form of Congress and our leadership that has, I think fiscal policy actually has a bigger role in the idea of full employment as opposed to the Fed. So, and so we get into situations where I'm sitting at my desk and the news story comes across, and it's, we may default on the US debt. The risk-free rate suddenly isn't risk-free. These are crazy ideas. These are things that we necessarily should never ever be talking about as a country. And the lack of confidence that comes out of these sorts of things, and so I really believe that although you say, Kevin, that these are all the same things to you, and that in the normal times we end up having optimizing growth because we are being very astute about how we are controlling inflation. There is, to me, a dynamic that the dual mandate creates. People looking at the Fed and saying, you know what, you're responsible, you have a dual mandate, let's get growth going. As opposed to maybe leading with pro-growth policies out of Congress, having a situation where we have tax reform, we have deficit reform, we have things that really, in my mind, would create a lot of growth, as opposed to putting it all on the shoulders of the Federal Reserve, which it seems to be happening. And that certainly has put us, I think, as far as the evolution of the Fed, in a much different place than for most of my career. And I think most private investors, when they think about their day jobs, when they're trying to take capital and apply it in a safe and attractive way, have serious doubts about the outcome of what you said. You said this is the third experiment, right? We don't like to hear that. We don't. Experiments are great for finding cancer and all sorts of things, but when we're dealing with something as basic as the voltage for the entire system, the experiment is not something we want to hear. We would I would tell you, if there are what, $8.5 trillion of treasuries outside of what the Fed has created recently. 5 trillion of those are held by 5.5 by outside foreign investors. This is a very, but we've got 8.5 trillion on the Fed's balance sheet. These are massive numbers, and this experiment is something that is so massive that you can't sit there with confidence and say you know what's going to happen, because you don't. And so that really is something that I think creates maybe some sand in the gears as opposed to helping us grow.
So I'm going to divert a little bit. I love you. You're challenging these central bankers. So, Kevin,
Shouldn't have let me come up here.
how do you? So, Kevin, how do you respond to this concern about the experimentation that you've been involved with recently?
So I'd say thanks, Al, for the softball question. I really it's good to be home. So a couple of things. First, so I'd agree in part and disagree in part. First, I would agree that the way that monetary policy was taught 25 years ago when I was a student was that what central banks should do is just see what the rest of Washington does, see what the Congress does, see what the president does, sit back, and based on that, then decide what would be appropriate for the central bank to do. And if you look in some sense at the financial crisis, by virtue in a panic of incredibly aggressive policy, which I would say, again, in the regime of a panic in 08 and 09, was certainly imperfect, but at some level necessary. The creating of new financial products to provide new credit into the economy was essential, and I would argue was what the Fed was designed to do. But I'll make two distinctions. We've been out of a financial crisis, out of a panic in the US really since 2009. And in some sense, while there's excuses for why the economy has done what it's done, the economy's actually been reasonably stable for the last 5 years at a level of growth that we in the US are and should be uncomfortable with. So I distinguish the time regimes between the 08-09 period and the period of moderate economic growth, and I would distinguish the role of the central bank and the importance of the central bank's actions in those periods. So again, monetary policy, as was taught, again said we should sit back as central bankers, see what the rest of Washington does and take policy. But I'm afraid that Washington learned one very bad lesson from the financial crisis. And that is they don't have to do very much because Ben Bernanke and his squad, we can pull a rabbit out of the hat.
Yeah.
And in some sense, in the darkest days of the crisis, that's what we did. And I would argue that's what we did with reasonable effectiveness. But if the lesson in Washington, the lesson in financial markets, is that the Federal Reserve can always pull rabbits out of the hat, that the Federal Reserve can take the economy today that's growing in the low 2% range, and by virtue of our mystical powers, turn this into a 3.5% growing economy, bring new dynamism to the economy, lead to a proper allocation of resources, then I would say that misunderstands the state of the economy in which we find ourselves. So the Federal Reserve should not be a repair shop for broken fiscal policy and trade policy and regulatory policy. And Al, frankly, I worry that the rest of Washington has grown too reliant on us to pull this rabbit out of the hat. And as a result, it shouldn't be a surprise, putting Democrats or Republicans in politics aside, it shouldn't be a surprise that in this environment, we're not seeing the kinds of economic reforms that are pro-growth that the country needs on trade policy and regulatory policy and fiscal policy, because in some sense, the rest of Washington might have decided that making hard decisions is really not what they're in the business of doing. The hard decisions will be made when we sit around at the FOMC.
So, Governor Carstens, do you, where are you on this little debate between your two colleagues here? And do you feel like that the Federal Reserve's been experimenting over the past few years?
Well, I mean, first of all, I would say that the Fed is a fully consolidated, very solid central bank. And in a way, it's a real anchor for financial stability around the world. But it's important, I think, to make a distinction and to make it very clear that here in the US, you have this exorbitant privilege to have such an institution. And when I talk about the institution, I talk about probably the most essential element that the central bank needs to have to be able to do to fulfill its mandate under all different types of circumstances, and that is to have credibility. I think that the Fed has been able to intervene in the economy the way it has done without generating inflation, without fueling more instability into the system, because they have earned through the time, through decades, credibility about the fact that at the end of the day, the value of the dollar will be stable. That credibility that you have built through many, many decades is there. It's an asset, and it's an asset that you can use when you face extraordinary circumstances. And needless to say, you face extraordinary circumstances, and I think that the Fed board, the chairman, and so on, they did extremely good use of credibility. But as anything, credibility also has a limit, and it can be eroded. And here I fully concur with what Kevin was saying. I mean, at the end of the day, monetary policy cannot fix everything. And I would say most of the time what it really provides, it's time for other policies to kick in. I mean, there is obviously this political constraint that, for example, to do a major structural reform, it takes time. You have to debate it in Congress. There are many interests that are fighting against each other. And the FOMC is a very agile instance to make decisions. So I think that the flexibility, the mobility of monetary policy becomes very handy in time of a crisis. But most of the time, what it can provide is just a window of opportunity so that the country has sort of a breathing space for other very tough decisions to be implemented. Otherwise, growth will not kick in a sustainable way.
Well, I understand that you and your central bank and the U.S., the Federal Central Bank, have worked very closely together, and you can tell that is the way y'all answered the question. So I think we ought to hear from Mark. See, and it sounds like the central bankers think they did a fabulous job in 08 and 09, and
No, they did. And Kevin's point and Carstens' point, Augustin's point about what central bank needs to do in a crisis and be that lender of last resort and ensure liquidity to the system. I applaud what happened in that crisis. I still scratch my head as to why it happened, but apparently we didn't have the ability to stop it. So, but the point that I think is interesting from my seat, and all of this is way above my pay grade, so take it with a grain of salt.
His pay grade's better than ours. Are.
Well, that was the point. That was the point I was going to make. And it is unfortunate. I think when you step across the line with QE2 and QE3, and we move out into influencing prices not only in the longer-term rate curve, but also within the spread market by buying mortgage backs. I mean, this is a big, big move. Now, I will tell you that capital versus labor has different responses to something like this. I think capital has done a fantastic job of front-running the government and winning. But if you don't know what that means, it means that if you look at financial assets and what's happened to financial assets because of the QE policies, we're doing great. We're making so much money. It is great. I mean, the stock market's up 10% on average since QE began. The stock market was up 33% last year. The houses were up 11.5% last year. The haves are doing very well with this policy. That it's the have-nots that are struggling, right? Our participation rate is at 63% or something like that, the all-time low. And certainly, so one of the things that I think that is coming out of this situation is we've applied things that were absolutely necessary in the crisis. And to your point, the patient is fine, right? We're out of the hospital, we're playing ball with our kids, but we're still doing the same sort of things as far as very extraordinary policy. And so stabilizing that and getting back to something that I believe would be much more simplistic and something where I love your first comment about 25 years ago, what you learned in school, is that the federal bank waits and sees what the leadership in Congress is doing, right? And then they respond. So that's the idea of being a thermometer, right? You're watching what's happening, and we have so much confidence in your ability to do that, and then to respond appropriately. But we've changed to being not really a thermometer, more we're a thermostat now. We're really dialing it up and down across a lot of different markets. And so it's been very good for a lot of those that have capital. But I guess I have this doubt whether this is the right policy at this point in the cycle, and whether we should maybe not allow everyone to throw it on our backs, the Federal Reserve's backs, and get back to something that is much more of a thermometer as opposed to a thermostat.
So just to make sure I understand, so there was QE1, which occurred during the crisis.
Yes.
And TARP and other things that it sounds like you support. But then the QE2, QE3, where there's the continuation of buying bonds, you think was inappropriate?
Well, Al, if it's supposed to work, right, the money goes into the banking system, and those excess reserves get lent out, and then we grow our economy. It's not happening, right? The reserves are just building up, and they're not being used. Now, so the allocators of capital, I think they work on this idea that it's not like the field of dreams. You don't build it and they come. If there's demand, right? If there's demand for your products or your goods, then you meet that demand. And certainly you have to have good products, but that's the way our system should work. So if we've created so much capacity in the system by putting $1 trillion something of excess reserves into the system, it could be lent out to make, $13 trillion of loans, and it's not being used, then I think that's not really where our problem is. We don't have a capacity problem. We have a confidence issue on the other side about demand. So it's to the extent we continue down this route, everyone is worried about inflation. They're worried about the size of the balance sheet. They're worried about the exit. They're worried about interest rates. All those worry is certainly something that doesn't create that confidence, that creates that demand. And so that's kind of my perspective on that.
So despite what the Fed has done, the economy, as you pointed out, Kevin, continues to grow slowly. Much more slowly than during any recovery since World War II. What's the problem?
So I'll agree with much of what's been said, and I'll try to answer that, which is I don't think that the Federal Reserve at this moment, or even over the last several years, can in and of itself deliver the economic growth that the country is expecting. I don't think we should be in the business of over-promising and under-delivering. Agustín spoke about the credibility that Chairman Bernanke and his team inherited from Chairman Volcker and our predecessors. That credibility isn't an excuse to sit around and do nothing, but also at the appropriate time, I think what drives that credibility is to say, we have done what we can, and here are the pros and cons of it, and we are now to the edge of what we can deliver. So QE, after the crisis, was marketed as an ability to take the economy to escape velocity, and we're still not there. And so I think in a bit of self-reflection, introspection, we've got to ask ourselves whether the Federal Reserve can deliver that, or whether the difference between economic growth of 3+% and economic growth of 2% isn't outside the powers of the Federal Reserve. And I'll describe it this way. First, there's an old saw that says, what's the difference between 2% growth and 3% growth? And the answer is 50%. It's not 1. The answer is that is a fundamentally different economy that is growing at that level. Now, it might not be a different economy for those that are in the financial sector, but it is a different economy if we want to have an economy that is growing and driving productivity and standards of living. That's the difference between having an economy that's dynamic and one with a lot more social mobility and an economy that is more static. And the economy that we've seen over the last several years should really force us to ask these hard questions. So I'd make two other points. One is we should be open about the distributional consequences of QE, about the distributional consequences of what the Fed's doing. That doesn't make it right or wrong, but it means we shouldn't hide from it. When President Bush proposed changes in tax policy in 2003, the New York Times ran front page stories for days about what are the distributional consequences, who are the winners and who are the losers. When the Ways and Means Committee this past year talked about tax reform, they looked at distributional consequences. Well, we should look at distributional consequences of this kind of aggressive policy. That shouldn't end the debate, but it should be part of that discussion. And my argument now would be, in some sense, the tools that central banks have can mostly deal with balance sheets. By buying long-term assets like treasuries, which is something that we have very little experience in doing, what we're able to do is take those that have balance sheets and give them more wealth. But if you're like the 60% of the economy that's at the lower 60%, then you're living off your income statement. It's your W-2 income that matters. And my own judgment is the Federal Reserve can't do much to change incomes, real disposable incomes, which have been quite stagnant really over the course of the last several periods. But incomes can fundamentally change. It's just not within our powers to do so directly. So there's nothing like the kinds of policies that Congress should enact on a bipartisan basis to drive this economy stronger and higher. That is a real commitment to a robust trade agenda. That is a real commitment for our leaders to spend political capital and say the broad economic pie will get bigger, not smaller. And now I would argue in some sense the US has lost its voice on a robust trade policy. It doesn't just matter in terms of our own trade agenda, but when Agustín and I go to meetings of the G20, I would tell you when the US isn't pounding the table on the virtues of free trade and open markets, very few others are. The world, even though we talk about globalization, the world looks, to my eyes, more fragmented than we care to admit. Countries and banks are racing home to their domiciles, and that makes us all poorer. So a robust trade agenda, real fundamental tax reform, akin to what we saw in 1986 on a bipartisan basis, that lowered rates and took all the crony capitalism out of the tax code. Well, since 1986 to the present, we've had 22,000 changes to the Internal Revenue Code. And I would argue to you that very few of them have been growth-oriented, and most of them have been argued to find a lower tax break for a particular interest. We might like the interest, we might not, but that is very growth-defeating. And those are the kinds of things that Congress of all parties should be able to do. And I do think it's incumbent upon the central bank not to tell Congress what they should do with their pen, but if the chairman of the Fed, Janet Yellen, goes to her next Humphrey Hawkins hearings and takes a lot of hard questions about why aren't you doing more to help hardworking Americans, she should say, listen, this is what we're doing, and we think it is still marginally helpful. But if 12 months from now the economy is not growing at 3%, she should look back at the Democrats and Republicans on the Senate Banking Committee and say, let me be clear whose responsibility that will be. That won't be ours, it will be yours. And we're calling on you to make these hard decisions, and we don't really care that it's an even-numbered year and you have an election coming.
Absolutely. Absolutely.
So what are you running for, Kevin? I think we ought to get some questions from the audience. We have about 10 minutes left, and we request that there be no speeches and that the questions be very, very direct and short. So is there anyone out there who would like, I think we have microphones around, is that right? I see someone up there, third from the top. Somebody got a microphone? Pardon me? I'm confused.
They have to
here.
walk down.
If we can hear the question, we'll
Yeah,
repeat
just
it.
go ahead and speak. That'd be great.
Yeah, you were mentioning about balance sheet.
Yeah, we can hear you. This is great.
Okay, we are aware that the federal government has about $17 or
Would you, excuse me, I was supposed to do this and I didn't, and I apologize for interrupting. Could you identify who you are and with what organization, please?
Yeah, Ray McCormick, and Headwaters Merchant Bank.
Thank you.
I mean, we're aware that the U.S. government has about 17, 18 trillion in federal debt, but we talk about off-balance sheet liabilities. I mean, some people say that number's over 100 trillion. Could you talk a little bit about that and how we can deal with that as well?
Well, why don't we let Mark?
Sure. Well, I understand you're with a bank, right? So the other dynamic here that seems to be going on from a job creation, we all know that jobs in this country get built by small businesses. And who lends to small businesses? Community banks. And it's another good example of a crisis effect and then a normal time. So in a crisis effect, there's a lot of things we have to do. And we pulled Merrill, we pulled Goldman, we pulled all these broker-dealers into the banking system in order to allow them to have liquidity, to be able to borrow at the Fed window, and that was a smart idea. Today, we're suing them, we're fining them, there's all sorts of things going on, but the compliance burden that large, systematically important organizations or banks now have trickles down to the small banks.
Yeah.
And I would guess that at your bank, there's probably 100 to 300 basis points of cost in your compliance personnel that you have to hire in order to make sure that you don't end up to be one of these people in the paper. And so the growth of jobs from a regulatory standpoint, that regulatory arm and what we do with regulations for community banks or smaller banks needs to be consistent with what we do with monetary policy, right? If we could get the banks going again as far as lending and more profitable, I really think that would be something that would be very accretive in helping us deal with, I don't know, maybe 10 trillion of it, maybe not 100 trillion, but part of it, and certainly would be good.
Can I jump to Governor Carstens to address the other question that was raised, which is, what about the U.S. debt? As a very smart central banker who's not in the U.S., does it worry you that we have whatever 17, 18 billion on our books, but unfortunately, I think we are approaching 100 trillion in terms of off-balance sheet debt, such as the Social Security, Medicare, and all the entitlement promises. Does that worry you about the U.S., and what should we be doing about it?
Well, I mean, usually you can do debt sustainability analysis. Now, of course, you have to make assumptions about growth. You have to make assumptions about the capacity of the government to raise taxes and to be able to pay its debt back. And if you do that on the reasonable assumptions, you can come to the conclusion that today the U.S. government debt is sustainable. Now, of course, under those, in those estimates, there is implicit the fact that down the road, the U.S. will strengthen its fiscal position. There will be some form of consolidation, and I mean, it's very likely that the U.S. will need higher taxes as we move forward because those commitments need to be paid. Now, the U.S. economy is one that has a relatively low tax burden, at least if you compare it with respect to other advanced economies. So the potential of the U.S. economy to grow into the future and the capacity that will generate for the government to raise taxes makes many of us confident that the U.S. will be able to, obviously, to comply with its obligations. Something that probably in the short term is more scary is something that what Mark said, which is all these debates in Congress where, at some point, the U.S. government might reach its debt limits and that it might not might not have the ability to serve its debt. Now, that I think would be disastrous, not only for the world, but starting with the U.S. I mean, to put in doubt the honorability of a country such as the US to be able to fulfill its obligations, I think something you cannot play around with. So I think that's something where attention has to be paid and not play in the political ground a lot with that issue.
Thank you very much. He obviously is not running for political office since he's endorsed raising taxes, but.
I was a Minister of Finance, and I know how it takes effort to get the money to spend.
Right. So we have time for one more quick question. Who else in the audience has something, please? Yes, sir. Yes, sir, right here. Thank you.
Why is 2% targeted inflation achieved not tantamount to gradual serial default?
Good question. Did everyone hear that? Why is the 2% targeted inflation tantamount to?
Not.
I'm sorry.
Why is 2% targeted inflation achieved not targeted, not tantamount to gradual serial default?
Gradual serial default? Kevin.
I mean, this isn't fair. Ron, it's a shame we're running out of time, but Chairman Bernanke is really handle this.
He is
fine.
running.
So let me try to answer that, and
Yeah, we have 3 minutes.
and if I can, I'll try to dive into Augustin's part as well. So first, I think that so long as central banks around the world deliver on their promises, then the expectations among households and businesses know what to expect. They can price that into their businesses and their decision making. And so the stability in inflation, the stability in prices, the stability in expectations should allow markets to work just fine. I am sympathetic to your view, though, if there's a question about why 2%. And I would argue that there's really been no magic to that. With the benefit of hindsight, some people having seen deflationary risks in Japan, deflationary risks potentially in Europe, and at least talk of deflation in the US, which I don't think we're that structurally sensitive to, why 2 and not 1 or not 3? I think there's likely in central banking going to be a revisiting over those levels. I happen to think that a convergence of expectations of what inflation is appropriate is fine. And I don't think that in and of itself leads to serial default. What does lead to serial default is continuing to write checks with a series of obligations that we cannot deliver. So the $100 trillion of long-term unfunded liabilities, think about this as the greatest structured investment vehicle off balance sheet to your government that we don't count, we don't add, and we don't hold ourselves accountable to is the bigger reason to be worried. And here I'd separate two things. I'd separate short and medium-term deficits and debts from long-term debts. And the truth is, if we were growing at the level which we had been accustomed to, our deficit picture and our debt to GDP over the next several years would look a lot better. We should all worry in some sense, if we were to look at this president's budget or look at President Bush's budgets of old, how they calculate what our deficits and debts will be over the next 10 years. And they look at the Treasury yield curve, and they assume that those rates hold. Just to give you one statistic, if interest rates were to go 100 basis points, that's 1 percentage point more than expectations in this model, that would be another $1 trillion of debt on our balance sheet of the US government. Now in Washington, they might not be so sure about millions versus billions, but trillions they know are a lot of money. And we should all be very focused on what would be the implications if the interest rate curve were to normalize. And my own judgment is if the economy ultimately does as well as we expect, and I think it ultimately will, in spite of our best efforts to kill this economy the last several years, we've failed. The economy's doing fine, and it will do even better when policy gets a little bit better. So that's the short-term debt situation. The longer-term situation, the kind of structural reforms, the kind of honest promises we need to make to Medicare, Medicaid, and Social Security. There has not been a robust discussion of it. The president needs to lead on these issues. Every president does. And the sooner we take care of that, the less harm we can do to people's expectations, the more we can deliver on the promises. And so I think those challenges are very real.
I think we owe this great panel a big round of applause.